We talk about Europe all the time. Investors are very aware of the risks there. They're a little more concerned lately about what's going on with the Chinese economy. How slow is slow? That's why Stephen Ratner's op-ed in the New York Times caught my attention. He writes, and just returning from China, that on balance, people he met were firmly optimistic that the fundamental urge to surge remains. If anything, the intervening decline in the Chinese stock market had made them more enthusiastic about investing. This stood out to me today because this evening we're going to get Chinese GDP numbers.
I did not know that.
Right.
This is their first look to see if they're under 8%.
Right. And according to economists that we surveyed, 7.7% is the number after 8.1% the previous quarter.
Interesting.
Marked slowdown there. And in the Fed minutes yesterday, there was discussion about China. And the Fed, some Fed members said that there was a chance that China is undergoing a significant
They also had discussion about the Chicago
Stephen Ratner
Cubs.
may be excited about China, but it's also unrealistic to expect China to step into the void left by the U.S. in terms of being a global leader. So my morning must-read is an essay from Harvard professor Danny Roderick. He offers a template for what he thinks would make a winner in the new global economy. He writes, domestic demand-led growth will be a more reliable strategy than export-led growth. Emerging markets with a large domestic market and a prosperous middle class will have an advantage in this new global economy. China doesn't necessarily fit that bill just yet, but this is a challenge ahead for not just China, but India, Brazil, Russia, all the emerging markets of the world.